Whenever we take a loan out, it's important to actually record the balances to your accounting system. We need to be able to keep track of our outstanding balance and what we need to pay on a monthly basis, but we also need to keep an accurate listing of our assets and liabilities. Our balance sheet lists everything we own along with everything we owe. When we take out a new loan, the first thing that we need to do is ensure that we have our accounts set up. Let's say that I'm purchasing a new vehicle. The vehicle is going to be worth $1,000. I'm required to make a down payment of $100, and I will take a loan out for the remaining $900. The first thing I'm going to do is go into my lists, and in my chart of accounts, I'm actually going to establish the new accounts. First, there's the asset account. The asset account is where I'll list the full value of the vehicle. Now, depending on what your internal procedures are, you may have an individual asset account for each vehicle that you own, or you may choose to put all your vehicles in one account, as is in this example. In the liability section of our chart of accounts, we will now create a brand new account for our vehicle loan. In this instance, we will show each individual loan as we need to track our balances to stay within the terms of our agreements. Once I have established the loans, I can now set up my originating journal entry to record the new balances. To do this, I'm going to go to a general journal. In our general journal, I will now take the full $1,000 value of that asset and record it to my vehicle account. Again, it may be that you choose to have an individual account for each asset. Next, I will record the fact that I wrote a $100 check as my down payment, and next, I will record that my loan was for $900. The combination of my down payment and my loan will offset the full value of the asset. Once the loan is actually recorded, I can now write checks to my financial institution and break my payment into my loan principal and my interest. You will need to have an amortization schedule in order to do this. You can contact your financial institution and they would be happy to provide one for you, or you can use a spreadsheet program such as Microsoft Excel and create one for yourself. Please note that there are many templates that are also available that are preset to do just this for you. Once we know what our interest and principal payment is, we are now ready to write our check. When I write my check out, I will go ahead and write in the name of the financial institution, I'm calling it loan in this case, and the full amount of my payment. On the bottom of the screen in the accounts section, I will then break down my payment into the principal amount and any interest that is due. By breaking down my principal payment and my interest, I'll keep accurate results of what my balance actually is. You will note that interest can be broken down for each individual loan or can be grouped together. Again, your internal procedures will determine which method is best for you.